Hello and welcome to today's investment coffee break. Now, last year, one of the investment coffee breaks, we asked the question, is cash king? And this was really with a backdrop of really quite a challenging time for world markets. Today, we're going to briefly revisit that question, but more importantly, look at opportunities that might be presenting themselves to us with world markets and beyond. To help me do that, today I'm joined by Jarvis and Joy Moir, two of our investment managers at our Winchester office. Joy, can I start with you? Where were we with cash and what's the situation looking like now?
So in our investment coffee break in September 2023, as you say, Andy, we asked, is cash king? And this was a question we were getting a lot as cash was offering better returns than investing at the time. So as a quick recap, we looked at a graph which showed 2022 and 2023 and cash returns on the dark blue line. And you can see that that dark blue line was gradually going upwards as interest rates were increasing. And we then compared that to investing in world markets on the light blue line. So we could see that for most of this period, cash returns were actually greater than market returns. So understandably, clients were asking, should they be holding cash rather than investing at this time? And in September, when we were doing our coffee break, we did see that markets had started to give greater returns than cash, but it was dropping back down and there wasn't much to choose between the returns. If we then extend that graph out a little bit and look towards 2024 and where we are now, then we can see that that light blue line has ticked up sharply, and that's because markets have started to perform much more strongly as time's gone on, and really that meant that we started to outpace cash. And at the time of our last investment coffee break, we were anticipating that being a very short-term trend, that cash was outpacing markets, and we did expect to see this reversion of markets outpacing cash returns again. And of course, client portfolios have participated very strongly in this uptick. And since November time, we've seen some double-digit returns in portfolios.
Thanks, Joy. So that light blue line, of course, is the world stock markets of which the US are a component part. We know that the US has had a really strong run. With those clients maybe still invested in cash or having some money in cash, might they look at that and think, perhaps I've missed the boat here? What are your thoughts, Adam?
Well, I think to answer that question, it's important to look at what's driven the majority of those returns that we've seen of late, as the strong returns have certainly not been across the board. Now, this can be seen in this chart, which shows the US stock market, the S&P 500, broken down into different areas. What we've seen here is on the blue line, the 7 largest companies, which you mentioned there. They've been named the Magnificent Seven. These companies are Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, and Tesla. And you can see that since the beginning of last year, they performed very strongly. The red line, however, shows that the other 493 companies and how they've done. And whilst this is still positive, we've certainly not seen excessive growth, and we think there's some way to go. And the yellow line shows the performance of the whole US market. And in this context, it's important to note the Magnificent Seven now make up around 30% of the whole US market. So they really drag up the overall return of the market. So whilst we still want exposure and do have exposure to the Magnificent Seven, we don't want to have 30% of the portfolio exposed to them, particularly when some of their share prices are sitting so high. Now, in contrast, the other 493 companies look more attractively valued, and we're starting to see profitability and their earnings improve. To highlight this, we have another graph here which shows the earnings or profit growth year over year of, on the blue bar, Magnificent Seven, versus the other companies in the orange bar in the S&P 500. This shows actual results for the first quarter and second quarter of this year, as well as what market analysts are expecting going forward. This really shows why those large companies did so well last year, as they were really the only companies growing at any significant rate. For instance, if you looked at the first quarter results, of the Magnificent Seven versus a year ago, they were up 35%, so 35% improvement in profits, whereas the earnings for the other 493 companies in aggregate actually fell by 5%. So a big difference there. We do, however, think we're approaching a turning point where those earnings of the rest of the S&P 500 are expected to catch up and then in fact exceed those of the Magnificent Seven by the end of the year. This is where we think stock picking is going to be key. And I think this highlights some of the risks of just buying a simple tracker fund going forward. So to summarize, we still see good value in the US market, but from here, some of the best upside is probably outside of the very largest companies.
Okay, so if we're looking outside of the US, then do we see opportunities with other world markets?
Yeah, so that's a good question. And there's certainly opportunities outside of US equities. So if we look at this next slide, then we can see growth across various regions and the expected growth rates for 2024 in orange and then 2025 in blue. So here we can see that it's actually the UK and Europe that are set to improve going forwards. And they're growing at a faster pace than other regions, including the US, although they are coming from somewhat of a lackluster time recently. But this increased growth should be supportive for stock markets in this region. And this uptick is something we've positioned client portfolios for. It helps us diversify portfolios across regions and find those opportunities outside of the US. And as well as that growth tailwind, stocks outside of the US are also looking relatively cheap. So on this slide, if we take the UK as an example, then here on the blue line, we can see the price earnings ratio over time. So you can think of that as how cheap or how expensive a stock is. And the orange line depicts the average price to earnings ratio. So what's key here is at the moment, stocks in the UK are actually trading below that orange line, meaning that they're cheaper than their long-term average. And for clients, this offers us attractive buying opportunities. And it's really important to note here, actually, that whilst we are using the UK as an example, we're seeing similar trends in other regions such as Europe and beyond. And as well as that, profits of many UK and European companies have improved, but prices haven't actually gone up as much as the increases in profits. So to put this into context, while the FTSE 100 has recently reached all-time highs, many of the companies are still trading well below their US equivalents. And therefore, we don't need to see the profits dramatically increase. We just need sentiment to improve. So what that means for us is that we can pick quality companies to invest in at attractive prices and in growing regions.
Thanks, Joy. Adam, do we see any other opportunities outside of stock markets?
Yes, Andy, I think the real positive is that we're seeing attractive outlook for returns across different asset classes. And one of those is bonds, where we're now able to lock into attractive returns following a strong rise in interest rates. As a reminder, when we invest in a bond, we're agreeing to lend money to a government or a company for an agreed rate of interest for a set period of time. At the final maturity, we receive our capital back. Now, the past few years has proved a challenging environment for bonds. This is because of the relationship between interest rates and bond prices. This is depicted by the seesaw we can see here, whereby the interest rates rise, bond prices fall. And this is obviously what we've seen over the past couple of years. What is important is that the opposite relationship is also true. While we do not expect interest rates to fall down to just above zero like they were before, and the jury is still out about how many rate cuts we may see this year, we do believe that interest rates have peaked, and any movement back down will be helpful. At the moment, we have a preference for UK government bonds, also known as gilts. This is because we're attracted to their tax efficiency. There's no capital gains tax on gilts, together with the fact that they are viewed as a safe haven asset. Therefore, if we were to see a shock to markets and our more positive view on the global economy, the stock markets didn't play out, then government bonds would be likely to perform well and help protect portfolio values. We don't have time to go into it now in detail, but is this a tax efficiency that makes them look very attractive for high rate taxpayers as well, particularly when compared to cash, which we've touched on earlier. As we can buy them directly, there are also no third-party fund manager costs, and they're also quite useful for matching liabilities, such as for clients drawing income.
Thanks, Adam. I feel it would be remiss of me not to ask a question about the UK general election. It caught most of us by surprise, expecting it to be in the autumn, but of course it's now on the 4th of July. What are our thoughts? How do we think that the election and a potential Labour government might affect things?
Yeah, so there will certainly be new policies introduced, but actually from a market perspective, we don't see the election as having a huge impact. So we've seen already that the UK market is actually already looking cheap. And a lot of the earnings from UK companies are from overseas rather than domestic. So if you take the FTSE 100, for example, about 75% of their revenues are actually from overseas. But also markets do like certainty, and knowing who's going to be in government may mean that there's greater interest in the UK market, or at least not as much negativity. So whoever gets into power will certainly want to see interest in the UK market grow. And another important thing actually for us to remember is that things like interest rates, which really do impact markets, are now governed by the Bank of England and not the governments themselves. So while we're going to watch it keenly and we await further details on key policies, we actually don't expect the UK election to move markets to any great degree.
Joy, Adam, thank you very much. And thank you for joining us. As always, we hope you found that useful, and we look forward to you joining us again for the next Investment Coffee Break.